You're about to find out why the New Jersey Broadcasters Association is inducting Harry Hurley to its Hall of Fame. Live from the studios of Town Square Media in Northfield, it's Hurley in the Morning on WPG Talk Radio 1450 and WPG1450.com.
Hey, thank you. Welcome back. Halftime festivities were just amazing, outstanding. Oh, my gosh. Today, sun and clouds mixed, high 86. You heard the man say just a moment ago, parts of the state might hit 90 today. Winds out of the west-southwest at 15 to 25. Tonight, partly cloudy, low 56. Winds west-northwest at 10 to 20 miles an hour. And tomorrow, we drop temperature-wise quite a bit. High will just be 69 degrees. It's going to become very windy, 20 to 30 mile an hour wind tomorrow, steady out of the northwest, even a little bit heavier along the coast. Low tomorrow night, going all the way down to 48 degrees, about 20 degrees colder overnight in just 24 hours. And that's going to be like 69 the next day, and I think by Saturday we'll go back to 78. There may be some rain on Saturday, which we do need, and for allergy sufferers, it's only temporary, but it is delightful when that pollen gets driven down, and you'll see it all over your sidewalk. It's all over the cars right now. And then Sunday it will drop 10 degrees again, down to 69. So it's really yo-yo, up and down, all around. The following program segment is paid for by Chuck Malamut. He is here, a financial advisor at Morgan Stanley, been with us for almost 25 years. The information, views, and opinions expressed on this broadcast are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. With that, Chuck, top of the morning to you.
Good morning, Harry.
Good to see you.
Looking good today. How are you?
I feel well. I'm wearing a salmon-colored shirt today, and I'm feeling a little bit snappy, a little spiffy for the Malamut program. One of my listeners wrote me immediately upon the release of the news that Verizon is purchasing AOL. You are a certain screen name at AOL.com forever. I am Harry Hurley at AOL.com. And Verizon is buying AOL for $4.4 billion. Wow.
Harry, interesting deal. And I think if you take a look at what has happened with AOL, if you go back to the beginning of time, here was a company that was on top of its game. Then obviously sort of fell by the wayside with all the other tech wreckers, we'll call it. Got some new life with Time Warner. Ultimately spun out and re-IPO'd, so to speak. Tim Cook, I think, did a really good job over the last several years reinventing the company. I know you're not a big fan of Huffington Post, but that's sort of their claim to fame, along with a lot of advertising. So you have content, you have advertising.
1 out of 2 ain't bad. I'm a fan of the advertising, not a fan of HuffPost.
So what happens is this deal, if you take a look at Verizon, obviously needs content, to stay competitive, and they have the pipes, so to speak, to get it done. This deal, if it looks from what I'm reading and heard earlier this morning, they look to close sometime in the summer. I think that's actually pretty aggressive. 50, to get it done that quickly and get get everyone on board. $50 cash. It's not a stock deal. AOL shareholders, I think those that came on board in the last couple of years should be relatively pleased because the performance of AOL, I believe, since the time Cook took over, is up about 73%, outperforming the S&P 500. So, I mean, from what I heard this morning, the AOL name will continue, and it's just something that Verizon needs to sort of latch onto to help their pipes, so to speak.
So it's a good deal for them, and I agree with your rationale behind it. Chuck, good time now, and those just joining us, Chuck Malamut, our official financial advisor, and Chuck heads up his own team, the Malamut Group, at Morgan Stanley's Northfield office. 609-383-2010 is Chuck's phone number to reach the team there, 609-383-2010. Give us your market update, Chuck.
So, Harry, if you take a look at where we are this morning, I mean, we don't like to focus day to day. Usually, we have our show prep done from the prior week, and unless Monday, turns into a big day. Yesterday was sort of a yawner. The markets were down, but if you look at where we are today, the markets are now sort of grabbing on to global interest rates, particularly here in the U.S. And as a result, what is happening? We see all the futures down fairly significantly, and that is you take a look at what happened Friday, where we had a wonderful day. It was probably the best day in months. So investors were a little giddy getting into the weekend, and now all of a sudden, we're back focusing. Since we're done with earnings, we need to focus on something a little bit different. And what we're going to focus on now is the Fed. I think you and Kurt did a good job yesterday in your narratives, and the bottom line, and I guess how it's advertised is that unemployment has moved down dramatically over the last.
How do you say that with a straight face?
Over the last several months, so we are now at 5.4%.
5.4%.
Created.
Why don't they just make it zero?
Well,
because this is as fantasy as that.
It's not going to be zero. We know that.
220. Anything's possible, Chuck. 223,000 jobs, which probably will be revised downward, and they have taken some of the most amazing liberties in history at reporting this number. Do you know now they are the amazing Karnak, Kreskin, Uri Geller, all rolled up into one? They're assuming, hey, it's spring. Hi, it's nice, and this is how many jobs we're reaching into the sky and saying that there will be. There's never been anything like it, Chuck.
Well, Harry, I think let's take kind of a step back and see where we are.
And celebrate the 5.4%.
No, I'm not suggesting.
Not you, but like it's real.
We celebrate it, but I am suggesting that we take a sort of a historical look at it as to where we are and what has happened. Let's take a look at the Fed, because the Fed has basically stated they're going to keep monetary policy accommodative until such point in time that the objectives of full employment and price stability are reached. So I guess the number one question is, what is considered full employment?
Well, it used to be 6% unemployment was full employment. What happened?
That hasn't been bannered around.
No,
as to what that number is.
Because they've changed everything.
So really is what is that number?
Chuck, if it was really 5.4%, wouldn't employees have such an advantage right now, and employers would be having such a hard time finding employees? They'd be doing signing bonuses for nurses. Instead, you can't get a job in almost any profession. Young adults are coming out of college, which you got in 4 years, Chuck. Now it takes at least 5 years. They can't get a job. And yet we're to believe that we have robust, incredible employment and only 5.4% unemployment. Yeah, this is disgraceful.
So your point is very well taken, because if you take a look, Harry, at where we are, I mean, so let's think about this. If we are quoted full employment or close to full employment,
right?
Really, what the Fed needs to look at is wage inflation, and what is happening now, there is really no inflation in wages. So it's sort of you got a dual-edged sword here. Like, what is going on?
Employees went years, Chuck, without an increase.
And as you stated, I think maybe it was last week or the week before, you create a new job. If you're working multiple jobs, that's counted as
creation.
2 jobs.
That's right.
And if
you're working 2 lousy jobs, and they get credit for creating the extra job.
And I don't know if Kurt said it yesterday or I heard it somewhere else. The number of people that are now off are taken out of that number.
Yeah, that was me.
Was 90.
We have the lowest. It's
96 million, I think.
It's the lowest job participation work rate in history.
So, I mean, let's fast forward this a little bit, because the concern, if we looked at Friday, for instance, we had a big day, interest rates dropped, and now 2 trading days later, interest rates are moving back up again. So the market is going through this seesaw. There's a lot more volatility in the markets today than we have seen, Harry, over the last virtually, I think, 18 to 24 months. So unemployment now, it's fallen 4.6 percentage points.
Sure.
From the October. Why do I sense this?
Here's what I want to say to you, and it's from a friend of the program. Tell a lie, tell it often, make it big enough, and it becomes the truth. That's what they got away. They had a goal before the 2012 election to get unemployment to a certain rate. I remember people saying, there's no way. If you take all of recorded history, it would have to come down by so much. There's not enough time. I said it's going to get below. I don't remember at that time it was getting it below 8% or whatever it was. They did it.
It was 8%.
Right. They did it because they invented it. They just pulled it out of the sky and reported it as true.
So here's where we are. So we go from 10% unemployment in 5 years ago, less than 5 years ago, to 5.4.
Yeah.
But despite that, positive movement, and it's whether or not it's positive or how it's created or recreated, the problem that we have is that wage growth has virtually floundered. It's gone, as you mentioned a minute ago. Wages for production and non-supervisory workers were up 0.1% in the month of April.
And then go look at all the things, necessities that you have to purchase and how much they've gone up over that period of time.
So you have these conflicting signals right now, and the bottom line, if we do get stronger wage growth, it's a signal that the Fed can seriously consider doing something about rates, as a pickup in wages should help inflation push back higher, and that's what the Fed's long-term target is 2%. So on the flip side, from an equity investor's perspective, if we're able, or if the market is able and employment is able to push these labor costs higher, that should benefit the employees, should ultimately benefit the economy. But unfortunately, what will happen is it will, in all likelihood, squeeze margins, for these companies, potentially dragging down earnings. So you're at a real push-pull, and I think, as we talked about, the Fed is probably looking at I'm going to say, Harry, at the earliest late summer, probably mid-fall to late fall, early winter. And if you remember years ago, it seemed as if, and I don't remember the years it happened, but every year, every meeting you look at the Fed, and you had sort of that stair-step chart where every meeting you would increase 25, maybe sometimes 50 basis points.
Yep.
We don't envision, a lot of increases. The more, the economy is certainly being held back. And
is there a chance there won't be any? At the rate things are going?
Well, look, there's always a chance.
I mean, but would they just raise rates because they say months ahead of time that this is probably when we're going to do it, or do they then recalculate when we get closer? Let me give you a statistic, Chuck. This is the Malamut Financial Program. Let's inundate with not opinions but facts. Nobody's talking about this, but it is a stunning statistic. In a few quarters, we will approach 10 consecutive years in America without a single quarter being 3% or better in terms of growth. In our entire lifetime, Chuck, and I'm going to even double down on that, in the entire history of the country, there has never been a decade stretch where America has not grown by at least 3% in any quarter.
Well, Harry,
how about that?
It goes back to what we have chatted about on many occasions on your show, and that is, is this now going to be accepted as the new norm with respect to growth or lack of growth within our economy? In the meantime, I listened, yesterday, Harry, to the majority of your show. I was heading on the road, so I had an opportunity to listen to the radio pop. A perfect case in point is Atlantic City. I mean, it's just got to be awful living there with higher tax rates and cutting services. And And because that there is obviously no growth, it makes it very, very challenging for that municipality and, to make it. I'm not going to talk about, because you were right on it. I remember you and I chatting on Friday as you were receiving the information with respect to what was happening with Atlantic City. And unfortunately, and I like the mayor, and I know a lot of people that work in Atlantic City, but it's time. It's major changes have to be made. If the revenue is not there, how can you justify your expenses?
See, that's the point. It's hard, like the interview I had with Tom Forkin, the candidate from Atlantic City's first ward. Maybe that's popular, and I think that will help get you elected in Atlantic City's first ward, maybe. But is it realistic to say that you just have to find the money somewhere else and continue to feed the beast, feed the bureaucracy? Any single homeowner out there, if you were making $100,000, you had two teachers or two dealers, and you were making $120,000 a year, $60,000 each, and you either both lose your jobs or one of you loses your jobs, you can't spend what you used to spend, Chuck.
No, you have to readjust your budget.
Yeah, dramatically.
There are certain expenses that will be curtailed and or eliminated. And Atlantic City right now is in the crosshairs. And it's awful when people, either lose their job or have reduced hours and reduced wages. But, Harry, you and I have been fairly close to all this, and I'm not quite certain what the solutions are at this point in time.
Well, I think we both know what the solutions are. You headed at the top level. I headed at the top level, and I was at several properties that were in reorganization. Sometimes we had like a weekend. I was given a weekend assignment where I had to cut several $1 million, and I think I'm understating the case. It involved dozens of positions. It involved figuring out a plan to not let it affect service, to be as compassionate as we could be with those that we were laying off through no fault of their own. I did letters of recommendations for each of them, and I actually helped them try to get employment, but we weren't in a position to continue to fund the number of whatever you want to call them, 40-hour equivalents or whatever, and be able to do it in the present environment. Isn't that where we are now, Chuck?
Well, Harry, we are there now, and if you take a look at what has transpired in the equity markets, and if you take a look at, well-run companies today, either privately held or publicly traded, we were forced in 2008 and 9 to begin this process of readjusting wages and readjusting number of employees, readjusting because of a reduction in revenue. And now if you take a look at where the market is today, this particular quarter, we've had a fair number of companies miss the revenue number, which is a little discouraging. But they continue, for the most part, to get the earnings per share where they need to be to satisfy the shareholders and satisfy the markets. I think in municipal government, because they're not under the same, guise, so to speak, where you don't have, you're constantly being looked at on a day-to-day basis. There was an opportunity here where the municipalities were not adjusting as quickly as they needed to.
Exactly.
And now,
and I understand why, Chuck. It's hard. People have they have Cadillac health benefits, really nice salary, great spiffs. It's really hard to let go. But when you can no longer afford it, when it is completely unrealistic and unsustainable, something's got to give.
Yeah, and your comment that you made with Tom Forkin earlier as I was driving in about sort of at the end of the interview where the state threw that lifeline, to provide that short-term financing, to help Atlantic City. I kind of, chuckled, not chuckled, I snickered a little bit and said, well, geez, the state of New Jersey, certainly they do not have their financial affairs in order, and the market clearly understands it. So it's just simply amazing, Harry, for as much revenue that we can generate here with the populace and you're talking, especially in North Jersey, the average wage earner is certainly significantly higher than what you're getting in the majority of this country, that a business person or business people should virtually look at the state and say, okay, here's what we need to do.
But, Chuck, I agree with all of that. Here's the other problem, too, though. If you get litigious, take this into the private sector. Sometimes, and I know you've been in a position, of high authority, and I have been too, and you still are. But once you have an employee suing you, you can't help that person even against themselves. You can't have contact with them anymore. If they start suing the state in federal court for civil rights violations and all hell starts raining down, is the state going to be, doing, jumping for joy to do bridge loans and to help with $20 million to the school district and to do all that? They might say, hey, you know what?
See you later.
You're on your own, baby. Pay your taxes. You're on your own. Good luck. These are the rules. You've been playing by them. So the precedent is there. You can be unhappy about it now. But I think it's a very fine line between collegiality, if you will, between branches and trying to somehow establish or preserve your rights. I mean, for example, the Board of Education voted, I think, 5-4. I know they voted it down, but I think it was 5-4 last night. They don't want to cut the 226.5 jobs. Well, the state fiscal monitor can do it anyhow.
Yeah,
he has the authority. He can overrule the board. I believe he will overrule the board. And so their 5-4 vote, symbolic only, because I don't think it will be adhered to.
Yeah, and they're on, from what I understand, Harry, on a very, very tight timeline as far as notification, and I believe it has to be
Friday,
the 15th.
Or they have rehired
Correct.
Everybody.
So, the good news, I will give you a little bit of an update. I had an opportunity to get in Atlantic City over the weekend, Saturday, and the town was
is busy,
bustling.
Oh, yeah.
I mean,
Atlantic City is doing very well. Actually, you're privy to something that I am working on. I've written 2,518 words about Atlantic City. And if I dare say so myself, because nobody else could say it right now, because few have seen it, it will be coming out on June 5th in the New Jersey Lifestyle Magazine. But I think I nail exactly where we are right now, Chuck.
Harry, as I said to you, you gave me the opportunity to get a little bit of a preview, and obviously I consider myself fairly close to what's going on, because there was so much information in that article. I reread it 3 times to get to absorb it all. I'm hoping that when it hits the newsstands and people do read it, that they do spend the time to read the article thoroughly, because I think you've done a really good job capturing that information and then pushing it forward where the average person can understand.
I mean, we go all the way back to the incorporation of the city, to the first hotel in 1850. I guess it was a little bit later than the 1850s, and the whole history of Atlantic City, the different eras and moments of truth, from Prohibition to the 64 Democratic Convention to obviously the 76 referendum. We have Stockton President Kesselman in there. We have Paul Steelman in there, Glenn Straub. I mean, we have hit just all the different areas that are right now happening in Atlantic City. So I'll let everybody know when that's out, but I do believe that it goes actually to print and out in print on June 5th. Let's do this, Chuck. Let's get a quick time out, and when we come back, Chuck is going to share with us about the bond market volatility, corporate earnings, April jobs report we covered. Also, I want to ask Chuck if it matters. I guess it does, because even though Greece is tinier than the disproportionate reality that it seems to have, Greece has borrowed money to make a payment. They have another payment due in the not-too-distant future. Is Greece going to affect markets? We'll get all of this and more coming up with our official financial advisor to Hurley in the Morning, Chuck Malamut, his team, the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010 to reach Chuck and his team.
It may be unusually dry across the state. We do need some rain, but we are not looking at drought just yet.
The rivers are starting to flow below average. soil moisture is down. The reservoirs are about where they should be at this time of the year, which is over 90% full.
State climatologist Dave Robinson says there is no doubt, though, we could use a good rain. Mary Lee, the great white shark, now swimming off the coast of Asbury Park. She's being tracked using a device attached to her dorsal fin. If she makes it all the way back to Cape Cod, it would be the first documented mature female great white migration ever recorded. As passengers sat on the runway, pilots could not get on board a Spirit Airlines flight in Atlantic City because TSA agents had gone home. This happened on Sunday. Weather had already delayed the pilots, and at 5 p.m., the TSA agents left. They did get somebody to come back eventually, but that flight took off some 4 hours late. No comment from the TSA. Get breaking news, weather, and traffic alerts on your cell phone. Text news to 89,000. This is the Town Square News Network.
Lately, I've been experiencing a lot of stress at work. I even put on quite a few pounds. So frankly, I just don't have the energy to keep my wife happy.
All my husband does anymore is go to work, eat, and sleep. I feel like we're drifting apart.
Can you identify with these comments? Men, if you're experiencing low energy, weight gain, muscle loss, loss of sex drive, and ED, find out the causes by attending a seminar on men's health Saturday, June 20th from 10 till noon at the Seaview Hotel and Resort in Galloway. The seminar will feature New Jersey's top doctor of 2014, Dr. Brian Steitzner, director of the Institute of Men's Health and a board-certified urologist. Men and women are invited to attend this life-changing seminar. Cost is $10 per person or $18 per couple. Register early for discounted pricing. A delicious breakfast is included. That's Saturday, June 20th, 10 till noon at the Seaview Hotel and Resort, 401 South New Road, Galloway. Sign up today at jspharmacy.com. That's jspharmacy.com. Sponsored by Jersey Shore Compounding Pharmacy.
Thanks very much. Welcome back to the program. 32 minutes past the hour. Chuck Malamud, our official financial advisor here on the Hurley in the Morning program. We're in our 25th year together, Chuck and I, here on Hurley in the Morning. Chuck has been at what he does as a financial executive longer than that. The Malamud Group at Morgan Stanley's Northfield office, 609-383-2010. Let's just get this out of the way because I just want to throw it into the discussion. Then we'll go on to the bond market volatility and your update there, Chuck. Greece has borrowed, I forget how much. I knew it at 3 o'clock this morning. It's 5 hours later, 5.5 hours later, and I forget how much. But they borrowed money to make a payment that was due. They have another payment that's going to be due in the not-too-distant future. Will this rattle markets today?
No, Harry. As we mentioned before, Greece gets in and out of the headlines. I'm not quite certain that they're ever going to fix their problems. I mean, this goes on. This has been going on for decades. So now we're at a point where it wasn't, borrowing the money. Everybody kind of understood that was going to be happening anyway, but
because they had no way to pay it otherwise.
But what is happening right now, and what has happened over the last several days, as we have worked off earnings, because 90% right now of the S&P companies have reported for the quarter. So now the market needs to focus on something different. So now we're focusing on interest rates. The 10-year Treasury, as we know it, right now is yielding over 2.3%. Doesn't sound like a lot, Harry, but it's the first time in 5 months that we've crossed over that number. So there's been a lot of selling pressure in the bond market that's pushed interest rates higher. There are, again, a little bit of concern about Greece, but more about what is happening here domestically with U.S. stock prices. So as you come in today, what happened last night, it started overseas and is now carrying here over the U.S. The majority of the international markets were down fairly significantly. But as we talked about, on many occasions prior, at the beginning of the year, what we're seeing is, again, outflows from domestic, inflows into international, and that's evidence in the returns. If put today aside, what is happening, the S&P year to date is up about 3.5%. Majority of your international markets are up high single digit, low double digits right now. So, the market is now focusing as well on volatility. The VIX, as we refer to it, it sort of fell by the wayside. Nobody really thought about it. And now it doesn't seem at a number of 16 that the VIX is high, but on comparative basis, it is high. And this bodes well for asset managers, the companies that are in the market day in and day out. They need that volatility so they can produce earnings. So it's not necessarily a bad thing, but I was visiting with a 401k client yesterday and their participants, and I think what really concerns me the most is that it's a smaller company, but if we can track their logins and the times they hit the websites, and they're virtually on the website every day.
Wow.
And that is not good. I mean, because most plans, do not have individual stocks. They have, or company stock they might have. They have mutual funds that get priced at the end of the day. So for the life of me, I can't understand why you're looking multiple times during the day. And the more times you look and you end up in a volatile situation and the markets go the wrong way, what's the first thing you're going to do?
You're going to cut and run.
You're going to cut and run. And what are you going to do with that? And what have you now accomplished by doing that?
You've guaranteed your loss.
It's great on the way up. But, unfortunately, what you have to take a look at is, this is,
Chuck, how hard is it?
We're in the third inning of an 18-inning game here.
How hard is it to be almost like a psychologist in a respect? Because when we had the downturn of 2008, those that bailed, they insured their position. They insured their loss, whether it's half a haircut or whatever was the end result. If you had the, intestinal fortitude, stomach, followed the advice of your financial expert who would guide that particular client based on their, investments, what they should do, people that hung in there, Chuck, they rebounded. Did they not?
Oh, absolutely, Harry. If you take a look, the S&P was at a 666.
Yeah.
I believe it was March 6th or March the 9th of 2009. I don't remember. I think it was March 6th. Might have been March 9. But, look at where we are today, on a comparative basis. And, the problem...
2105.
The problem,
crazy.
The problem that we had is that, when you're hearing every day and watching every day your assets, diminish or they're depleted, so to speak, half of a loaf of bread is better than no loaf. And, we battled through that. And I think you always kind of sleep with one eye open, and you're obviously very concerned, and you need that asset allocation, and you need to be, fully protected. But at bond yields where they are today, even with a 25 or 50 basis points, increase in Fed fund rates, it's still not going to get where you need to go to produce income.
Chuck, about 6-7 minutes left in your program. Corporate earnings.
Okay.
How are things?
So, as I mentioned a few seconds ago, earnings, about 90% of the companies have reported. And most have done a relatively good job in beating that hampered down number that was out there. So what is happening, earnings are ahead of expectations by about 7%. But the concern that we're having here is that revenues aren't necessarily in line with that. I think the most frustrating thing is when you look at those earnings come across the wire, you'll see a company get to the earnings per share projection or slightly beat it, but the revenue number is not there, and it's down.
So they're making it through managing expenses and things like that?
Yeah, and this is something, look, Harry, this is not unusual. Certainly technology has helped, but, revenue growth is down, going to be down about 3%. Earnings per share will be up about 3% year over year, or compared to what the analysts had projected. Energy obviously is an important part of the economy. And I think as you were chatting the other day on the radio about how you drove by in the morning and drove by later in the afternoon, and prices were up 8 or 10 cents at the pump.
It was crazy.
So what is happening? If not,
it's now over $2.50.
Not that I'm suggesting you take energy out. You can't. But you take a look at what's happened in that marketplace, that the sector earnings will probably have advanced in double digits throughout the entire, all the S&P companies, but 500 companies. But the bottom line is, energy is an important part, of the economy. If you take a look at the price at the pump, as you mentioned, right now, nationally we're about $2.66. We were at 230 at the beginning of the year. Still down fairly substantially. You were about 368 a year ago. So I think your question was last week, is this going to have a positive impact on summer driving? Yep. And I think it will.
I do too.
Unless you get a big spike.
It is sneaking up there, though. It went up another 4 cents from yesterday. It was 247. I went by this morning. It's 251.9. So it's been creeping up quite a bit since the days of, what did it finally bottom out at, 180?
We were about, I remember driving, excuse me, locally it was about 170, 172, but it was only there for a fraction of time. But I think what's important is we talk about energy, for many, many weeks, it was the worst performing sector in the S&P 500. And actually, year-to-date right now, energy is up about 2.7%. But the one thing we talked about, if rates moved higher, that it's had an impact on utilities. And utilities are down about 6% year-to-date. The winners, healthcare, materials, and consumer discretionary. Financials are starting to get a lot of attention, especially if rates do, in fact, move higher. That benefits financial companies, especially your banks.
Absolutely. Now, the flip side, the upside to interest rates, ultimately, whether it's the Fed at initially 25 basis points every so often, finally yields in some of your demand deposit accounts and some of your basic savings instruments will actually start, because a lot of people depended on that for many, many years. They had a certain yield that they could count on. And obviously, when we've been in this unprecedented, almost zero interest rate environment, the positive yield has been affected.
Well, Harry, for the life of me, I still can't figure out how those that are on a fixed, income, so to speak, and are retired and had savings, how they were able to fill that void, unless, and this is sort of a double-edged sword, unless you were willing to take on a little more risk, and
which in previous days they wouldn't have done.
Right. Now, here's what happens, and this is sort of a I don't want to call it a word of caution, but something that investors need to be certainly looking at. If in fact rates move higher, that could have, and they move quickly. I don't think that's going to happen. But if they do, not necessarily the Fed, it's the market now. Mm-hmm. If rates move quickly and dramatically, it could trigger, a correction in the equity markets. And I think what your listeners need to recognize is if you need to really take a serious look at what you own. I mean, it's I think the biggest fear that we have during our day is when we get a phone call from a client and they've discovered this incredible investment that produces inordinate returns compared to where the market is. And I remember having a conversation with a client yesterday where they were guaranteed a certain percentage rate. And I said, well, who's guaranteeing it? Why are they guaranteeing it? What happens if the guarantee's not in place? It's not as if, and you talked about this yesterday, the full faith and credit of the U.S. government, what is backing our currency. So there's a lot of confusion. And I think ultimately, what can happen is that if you're not prepared, it could spell ultimately trouble for you. So you got to understand what you own and why you own. And something, Harry, we've talked about for years.
Yep, and I know you got to get out of here in the next minute or so, Chuck, but let me squeeze this in because for those listening to Chuck for almost 2.5 decades, this is 25 years, old, this comment. But Chuck, whenever I'm speaking with you or speaking about you when you're not here doing your show, I talk about Chuck Malamut, your perfected concept of total asset management, coupled with the all-important asset allocation. And that's only as good as the last time you've actually sat down with the client and reviewed current circumstances, because if interest rates change, then asset allocation could easily change. You might take a whole nother look at things, correct?
Harry, I think more importantly than that is the fact that if a client's needs, wants, desires, and risk tolerance have changed, that is critically important. And the last thing we want to have happen is we find out sort of after the fact that things have changed with a client. And, we always encourage that dialogue so we understand where the client, plans on going in the next 5, 10, 15, 20 years.
Anything you want to close with?
No, Harry, I think, look, today, as I mentioned to you, really positive news for the market with this AOL deal with Verizon. That caught everybody by surprise. Unfortunately, I think we're going to have a little bit of tough sledding today. And I think the concern that we have to, be really worried about is, what's going to happen with global rates. If they go quickly in an upward bias, that could spell some trouble for the markets.
Chuck Malamut, for all of your financial planning needs, tell him that I sent you Hurley in the Morning, please. And to reach Chuck Malamut and the Malamut Group at Morgan Stanley, the Northfield office, 609-383-2010. The following program, paid for by Chuck Malamut, a financial advisor at Morgan Stanley. The information you just heard, the views and the opinions expressed on this broadcast are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. And Chuck, we will reconvene 1 week from today.
Harry, thanks for having me. Enjoy the rest of your week.
You do the same. Stay cool today.
We'll try.
Might hit 90. We'll be back in just a few minutes. Stay with us. Dr. Zlotnick in the 9 o'clock hour. If you want to jump in, wide open forum to end this hour begins right now. 609-407-1450. This is WPG Talk Radio 1450. I'm Hurley in the Morning, and we are South Jersey's talk station.